You want to learn about the various different business entity types, which one works for you, which one has low taxation, which one gives the best opportunity for you becoming the next unicorn, or who knows, maybe even Google, right? Kenner French with vastsolutionsgroup.com here. Today we're going to be talking about exactly that, the various different types of business entities. When beginning a business or enterprise, you must decide what form of business entity to establish. Your form of business determines which type of tax return you must fill. Let's go ahead and outline the specifics right here. We got sole props, we got partnerships, corporations, S corporations, and LLCs. Now, specifically, sole proprietorships or sole props. A sole proprietorship is someone who owns an unincorporated business by he or she's self. However, if you are the sole member of a domestic liability LLC or limited liability company, you're not a sole proprietor if you elect to treat the LLC as a corporation. Now, to a partnership. A partnership is the relationship between two or more people to do a trade or business. Each person contributes money, property, labor, or skill, and also shares potentially in the profit or loss of the business. Let's go to a corporation. In forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. A corporation generally takes the same deductions as a sole proprietorship so you can figure it's taxable income. Corporation can also take special deductions. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. A corporation conducts business, realizes net income or loss, hopefully not, pays taxes, and distributes profits to shareholders. The profit of a corporation is taxed to the corporation when earned and then is taxed to the shareholders when distributed as dividends. This creates a double taxation. The corporation does not get a tax deduction when it distributes dividends to shareholders. Shareholders cannot deduct any loss of a corporation. If you are a C Corp, again, C Corporation or C Corp, use the information that are outlined on the IRS website to learn about the specifics when you're required to file. S Corporations or S Corps are really corporations that elect to pass corporate income, losses, deductions, and credits through to their shareholders for federal tax purposes. Shareholders of S Corps report the flow-through of income and losses on their personal tax returns and are assessed tax at their individual income tax rate. This allows S Corps to avoid the double taxation on the corporate income. S Corps are responsible for taxes on certain built-in gains and passive income at the entity level. To qualify for S Corp status, the corporation must meet the following requirements, very specific here. You need to be a domestic corporation, have only allowable shareholders, may be individuals, certain trusts and estates, may not be partnerships or corporations or non-resident alien shareholders. You have no more than 100 shareholders. Also, have only one class of stock. Not be an ineligible corporation, by the way. That's an important distinction, as a matter of fact. An LLC or limited liability company, now that is a business structure allowed by state statute. Each state may use different regulations, or, by the way, you should check with your state if you're interested in starting a limited liability company. They're started at the state level. Owners of an LLC are called members. Most states do not restrict ownership, so members may include individuals, corporations, or other LLCs and foreign entities. There is no maximum number of members. Most states do permit things called single-member LLCs, those having only one member. A few types of businesses generally cannot be LLCs, such as banks, insurance companies, as an example, and a few others. Check with your state's requirements and the federal tax regulations for more information. There are special rules for foreign LLCs. That's the reason I mentioned them. Time to talk about classifications of LLCs. Depending on the elections made by the LLC and the number of members, the IRS will treat an LLC as either a corporation, a partnership, or as part of the LLC's owner's tax return. It's called a disregarded entity. Specifically, a domestic LLC with at least 2 members is classified as a partnership for federal income tax purposes unless it files a certain specific form, and we can get into that if you call the office. For income tax purposes, an LLC with only 1 member is treated as an entity which is disregarded as a separate from its specific owner unless it files certain IRS forms, etc. Now, however, for purpose of employment tax and certain excise taxes, an LLC with only 1 member is still considered a separate entity. Hope this helps in providing a real basic understanding of the various types of entities. Business ownership has its challenges for sure, but few times have I ever regretted becoming an entrepreneur. Once again, Kenner French, an executive at vastsolutionsgroup.com, and I've authored a couple of books, with another on the way, by the way. I like speaking, and I live on an island, that being Bainbridge Island, Washington. If you have any questions, go ahead and call us, 888-808-8278, or check out the website.